Hello and how are you? My name is Dr. VICENT STANSLAUS and I am an economist and a lecturer at the Open University of Tanzania, Faculty of Business Management, Department of Marketing, Entrepreneurship and Management. Today I would like to take you through the concept of market equilibrium. And I will start by defining the concept. When we talk of market equilibrium, before you achieve what we call a market equilibrium, you should have first of all gone through the concepts of demand and supply, and you should be aware about the demand equation and the supply equation, because it is from the two equations where once you solve them you get what we call equilibrium price and equilibrium quantity demand and quantity supplied. So allow me to go direct to the concept of market equilibrium, because the other calculations are in the previous videos. So when we talk of market equilibrium, we are referring to the condition that exists where the quantity supplied and the quantity demanded are equal. At a point where quantity demanded is equal to the quantity supplied, that is where what we call the market equilibrium. And in a free market, the forces of supply and demand determines the equilibrium quantity and equilibrium price, as I said. So looking at the diagram, you can actually see that we have the two graphs, the demand. Of course, we have a graph that shows the demand curve and the supply curve, and on the vertical axis we have the price per DVD, and on the horizontal axis we have the quantity of DVD supplied and the quantity supplied. So you can see that the price ranges from $1 up to $5, and the quantity demanded and the quantity supplied ranges from 1 up to 12 units. So I understand you already know how to draw the supply curve and the demand curve, and in this case we are interested at a point where quantity supplied meets quantity demanded. That is where we determine the equilibrium point. So when the price is $2.5, the quantity demanded is 4.5 quantity demanded and the quantity supplied. So at that particular price, that is where the quantity demanded and the quantity supplied are at equilibrium. In other words, that is where there is an agreement between the supplier and the buyer, between demand and the supply. The supplier and the buyer, the seller and the consumer have come to an agreement that when the price is 2.5, the seller is willing and able to sell 4.5 quantities, and the buyer is willing and able to buy 4.5 quantities of DVDs. So that is what we call equilibrium price and equilibrium quantity demand and quantity supplied, or that is what we call the market equilibrium. So for example, you can see that we have what we call excess supply and excess demand. That is the situation where the demand, the supply for goods and services, for excess supply, it is the situation where the supply for goods and services exceeds the demand. So you can see that the supply curve is above the demand curve. That is why we are saying that there is excess supply, and the excess supply occurs at a situation where there is higher price in the market, because as you know, suppliers are willing and able to supply more quantities of goods and services when the price is high in the market. So the price of DVDs when it is above the equilibrium price of 2.5. When it increases up to 3.5, you can realize that suppliers are willing and able to supply more quantities of DVDs. But remember that from the law of demand and supply, that the higher the price, the lower the quantity demanded. When the price is high, consumers will buy less of a commodity, and when the price is low, consumers will buy more of the commodity. That's what I was trying to say. So it means that the forces of demand and supply in that case will have to move the quantity demand and the quantity supplied back to the equilibrium. That's why you can see the arrows for excess supply are slowing downward from 3.5. It will push back the price to equilibrium to 2.5, and even the quantity demand will also, the quantity supplied will also be reduced from the indicated 6.5 DVDs to back to the equilibrium of 4.5 DVDs. And that's because of the forces of demand and supply. And for excess demand, that's the situation where the demand for goods and services is higher than the supply for goods and services. And as you know, when there is a lower price for goods and services, consumers are willing to buy more of a good. So that's why you can see that when the price is 2.5, so when the price is $1.5, you can see that consumers are willing and able to purchase. Suppliers are discouraged from supplying the goods and services. That's why the supply is reducing to 2.5 units, but the demand is increasing to 6.5 units. But because of the forces of demand and supply, it means that suppliers will also be defending their position, and the consumers will as well be defending their position, and in the end, the price will be pushed to the equilibrium price, and the quantity demanded and quantity supplied will also be pushed back to the equilibrium position, which is 4.5 units. So that diagram explains two issues. One, the equilibrium point, market equilibrium, where the demand meets the supply, and the equilibrium price itself. And two, that there is excess supply and the excess demand, but because of the forces of demand and supply, the equilibrium point will be restored. That is why you are seeing the arrows for excess supply are slowing downward back to the equilibrium point, and the arrows for excess demand are moving upward back to the equilibrium price, and the equilibrium quantity demand and equilibrium quantity supplied. So you can see that we have point E. That point E is the point of market equilibrium. So we also have the types of equilibrium, where we have the equilibrium itself, which refers to a state in which the goods produced is equal to the goods consumed. We have the partial equilibrium, which states that in an economy, it is a state in economy where market is cleared of some specific goods. So that's not a general equilibrium. It is just a partial equilibrium where the supply may not be specifically equal or exactly equal to the demand, or the quantity demand may not be exactly equal to the quantity supplied, but the price is determined. However, the quantity demand and the quantity supplied are not exactly equal, but they are at a partial equilibrium. And for the general equilibrium, it describes equilibrium in vast forms. And we have the disequilibrium analysis, whereby normally it persists in markets where the government and the other bodies impose artificial restrictions on either price or quantity. And as we said as we are discussing the excess supply and the excess demand, apart from the market forces of demand and supply, which restores back the equilibrium point, also the government may intervene at some point to protect the interest of the supplier, so that the price is moved back to the equilibrium price when there is excess demand. And when there is excess supply, the government may intervene to control the prices of goods and services to restore the equilibrium point, so that the consumers are also protected. Because when the price is high, it can lead to inflation. But even when the price is low, it can also lead to deflation, where there is a slow or a decrease in prices, which can lead to the slow growth in an economy. So that's what we are talking about, the disequilibrium analysis, where the government and the other bodies may impose artificial restrictions on either price or quantity to restore back the equilibrium. And the disequilibrium analysis puts the market process and the role of arbitrage in it into higher relief. And the equilibrium analysis is used to monitor demand and supply of the commodity. So I am not going to go into the mathematical part of the topic, as I said earlier, because they could be already covered. But in this simple example, we had the quantity supplied. We have the supply equation, which is 4 plus 4p, and the demand equation, which is QD, which is equal to 100 minus 2p. So when you solve these two equations, quantity demand equals to 100 minus 2p, and the quantity supplied is equals to 4 plus 4p, I understand you know how to identify the supply equation and the demand equation. So when you solve these equations simultaneously, you will realize that the quantity supplied is equal to 68, and when you substitute 68 of course when you already have the QS, it is easier for you to get the price. So when you solve for price, you get 16. So P is equal to 16, and the quantity supplied is equal to 68. And when it is at equilibrium, at the equilibrium point, it means that the quantity demand is equal to the quantity supplied. Therefore, 68 is equal to 68 when the price is 16. So in a nutshell, it is the stable equilibrium, because the price of 16 sets 68 quantity demanded, 68 quantity supplied at the equilibrium. In this case, any divergence from the equilibrium sets up forces which restores the equilibrium. Therefore, no forces to push the price further away from the equilibrium price. So when we talk of the market equilibrium in a nutshell, that is what we are referring to. There are more videos on how to calculate the equilibrium price and the equilibrium quantity demand, and also I have another video which is also trying to explain how is the market equilibrium obtained, both mathematically and in an explanation. So what we do, that what I can emphasize is that when you go to the market, when you meet a supplier, when you meet a consumer, if you are a supplier, when you meet a consumer, or if you are a producer, when you meet a consumer, try as much as possible to bargain, so that you reach at a point where both of you agrees on the price and on the quantity to be supplied or the quantity to be consumed. I thank you very much, and I wish you the best in this very important and very wonderful concept.